Hello, knowledge seekers. Welcome back to the Knowledge Emporium, your hub for understanding the intricate world of finance, regulations, and more. Today, we're diving into a hot topic: conflict of interest rules for market regulators in the US and UK, sparked by the recent Hindenburg allegations against the Sebi chief. So, grab your notepads and let's get started. US-based short seller. Hindenburg Research recently alleged that Madhabi Puri Buch, the chairperson of India's Securities and Exchange Board of India, had invested in an offshore fund linked to the Adani Group a few years ago. Hindenburg suggested that this could explain Sebi's inaction against suspect offshore shareholders in the Adani Group. Buch, her husband, and Sebi have denied these allegations. The allegations have raised important questions about the transparency and accountability of market regulators. Let's explore the conflict of interest rules in the US and UK to better understand the context. Let's first look at the United States. The Securities and Exchange Commission, or SEC, is governed by strict ethical conduct standards. These standards are designed to ensure that the SEC operates with the highest level of integrity and impartiality. Prohibition of personal interest. Employees are prohibited from participating personally and substantially in any matter in which they have a financial interest. This ensures that decisions are made without any bias or personal gain. Imputed interests. This includes the financial interests of the employee's spouse, minor children, and other close relations. The idea is to prevent even the appearance of impropriety. Penalties. Violations of these standards can lead to corrective action or disciplinary action against an employee. In severe cases, criminal penalties may apply for violating criminal statutes in the regulations. The SEC uses a personal trading compliance system, or PTCS, to track employee holdings. This system is crucial for maintaining transparency and accountability. SEC employees must obtain pre-approval for securities transactions made by or on behalf of themselves, their spouses, their minor children, and other close relations. The PTCS is used for the submission and processing of pre-trade requests for securities transactions and for the annual certification of holdings for the previous calendar year. After SEC employees submit and process pre-trade requests for securities transactions, the Office of Ethics and Compliance reviews and approves or rejects them. SEC employees are also required, with certain exceptions, to report and certify all securities holdings in an approved manner. Anyone who receives a conditional offer of employment from the SEC must report all securities holdings after acceptance of that offer and before commencement of employment with the Commission. In addition to these general standards, the SEC has supplemental standards of ethical conduct for members and employees. These prohibit employees from transacting in securities of companies under investigation, engaging in short selling, transacting in derivatives, participating in IPOs for 7 calendar days after the offerings, or purchasing or carrying securities on margin loan. Now, let's cross the pond to the United Kingdom. The Financial Conduct Authority, or FCA, has its own set of rules designed to maintain the integrity of the financial markets. The FCA defines a conflict of interest as a situation where it could be perceived that an employee's actions could be influenced due to their relationships, access to information, or personal financial position. This broad definition helps to capture a wide range of potential conflicts. Employees must complete a full review of actual or perceived conflicts of interest annually. This ongoing review ensures that any new conflicts are identified and addressed promptly. Activities related to conflicts of interest are recorded in a conflict of interests portal. The information is kept confidential with the employee's manager and those with a need to know, including the conflict of interests team and the control room. Employees must disclose their personal positions, including holdings in listed companies, direct holdings of securities, and related investments in non-UK financial firms if they have a UK-based subsidiary or parent company. They must also disclose e-money balances in various types of online wallets or prepaid cards above £5,000 and any other financial relationship that could reasonably be considered a conflict due to its sensitivity. Breach of these policies on conflict of interest can lead to disciplinary action or even dismissal. The FCA takes these rules seriously to ensure that its employees act in the best interests of the public and the financial markets. So, how do these rules compare, and what implications do they have for the Hindenburg Allegations? Both the SEC and FCA have strict rules about disclosure and participation in matters where there's a conflict of interest. The SEC has a more detailed system for tracking and pre-approving trades, while the FCA has a broader definition of what constitutes a conflict of interest. In the case of the Hindenburg Allegations, the key questions are: did Buch make full disclosures to the government, and did she recuse herself from investigations where she had a direct or indirect interest? These questions are crucial for maintaining the public's trust in the regulatory process. Let's look at some examples and case studies to better understand how these rules are applied in practice. In the US, a former SEC employee was found to have violated conflict of interest rules by participating in an investigation involving a company in which they had a financial interest. This led to disciplinary action and a loss of trust in the employee's impartiality. In the UK, an FCA employee was dismissed for failing to disclose a financial relationship that could have influenced their regulatory decisions. These examples highlight the importance of strict enforcement of conflict of interest rules. The impact of these rules on public trust cannot be overstated. Market regulators play a crucial role in ensuring the integrity and stability of financial markets. Any perceived or actual conflict of interest can erode public trust and undermine the effectiveness of regulatory actions. In the case of the Hindenburg Allegations, the public's trust in Sebi's ability to regulate the market impartially is at stake. Transparency and accountability are key to maintaining this trust. Looking ahead, what are the future implications of these allegations and the rules governing conflict of interest? Strengthened regulations. The allegations may lead to strengthened regulations and more stringent enforcement of conflict of interest rules. Increased transparency. There may be a push for increased transparency in the disclosure of financial interests by market regulators. Public scrutiny. The public will likely demand greater scrutiny of regulatory actions to ensure impartiality and fairness. That's all for today, knowledge seekers. Remember, these rules are in place to maintain the integrity of our financial systems. Thanks for joining us, and don't forget to like, share, and subscribe for more insights from the Knowledge Emporium. Peace.